Good morning, and thanks so much for being here today. I really appreciate your time. For those of you who I don't know, my name's Mark, and professionally, I'm a lifestyle financial planner. I typically work with women in finance, helping them identify, achieve, and maintain the lifestyle they want without the fear of running out of money. Personally, I'm married to my beautiful wife, Nicole. I'm a father to two amazing children, Luke and Sephora. And my family is really my purpose. They're the reason that I do what I do every day. And together we're on a journey to build our best lives together. My clients are also like my family, and I feel blessed that I get to work with them, helping them achieve their best lives. Our guest this morning is Graeme Saggers. He is a tax director at Nolan's Tax. Professionally, Graeme's a chartered accountant. He also holds a master's degree in tax. He specializes in tax consulting with a specific interest in advising on estate planning matters, both in South Africa and cross-border scenarios. So really well equipped to tackle this topic with us today. Graeme's presented and published various research topics on tax, both locally and internationally. Excuse me. And he's been a guest lecturer at UCT and University of KZN. Firstly, Graeme, also a husband and father to two kids. He also lives in Cape Town, but he prefers to be as far away from the hustle and bustle as possible. Has chosen to make Nuduk his home. He loves being outdoors and is super passionate about trail running, so much so that he's currently training for the Ultra Trail Cape Town, which is a 65-kilometer trail run. Good luck with that, Graeme.
Thanks, Mark.
Just some housekeeping. We're going to keep the webinar very informal. We welcome all and any questions as they pop up. Please just put them in the Q&A or the chat function, and we'll address these during, and we'll leave some time after the presentation to get to them as well. This is not going to be one of those death by PowerPoint presentations. We're rather going to have a conversation between Graeme and myself, and we'd love for you all to join us at any time. So keep the questions coming. We're going to try and keep it to around 45 minutes so that we can finish prompt at 11, just be respectful of your time. I think before we hand over to Graeme, I would just like to maybe start with a quick poll. If we can just get an idea as to how many of you are actually considering immigrating within the next 12 months. It popped up, if you can just answer there. Right, so maybe while we wait for some answers on that, Graeme, you can quickly introduce yourself again, thanks, and then maybe if we could just start with the first question of formal immigration versus financial immigration. Is there a difference? If so, what is it? What does it all really mean?
Great, thanks, Mark, and thanks for having me. I'm really excited to spend the next hour with you and all your clients. Good to meet all of you that I don't know. I think as Mark said, I'm based here in Cape Town, and I've lived here for almost 12 years now, coming from KZN originally, and I'm really one of those irritating Cape Townians now that can't think that there's a better place in the world to live. I love it here, and a day like today is fantastic. But doing what I do, very often clients come to me and say, for whatever reason, I'm leaving the country. I've got a job, or I really don't like sunshine and I want to go and live in England where it's rainy all the time. So what we do is help you move abroad and get all the relevant kind of compliance in place and all the other bits and pieces. The world of immigration has gone through a lot of changes in the last few years from a South African perspective, brought on mainly around the change in one very specific tax law. In the past, there was this exemption on South African tax residents for their foreign employment income. And the Treasury looked at this and imposed a law that limited that exemption to now 1.25 million. This has caused a lot of chaos, and we've all seen loads of press, and a lot of South African expats have become very worried that all of a sudden now their foreign earnings will be taxed in South Africa. What this has meant, which is in my view been a positive thing, is it's helped people really engage in the concept of tax residency and determine whether they are on tax residents. And that's what we're going to, I think, spend some time on today. And all these kind of concepts we talk about are linked. But on that foreign employment exemption, once we kind of take people through the process of understanding their personal circumstances, we found that very often that law change doesn't affect too many people, but it is good for people to understand the different kind of residency concepts. So before we look at the kind of financial immigration, I think it's worth just understanding what we mean by the term resident. In South Africa, when we talk about residency, there's really three aspects to it. So there's your citizenship, or your immigration status, and that's determined by kind of the Department of Home Affairs and whatever similar department is in the country you're going to. Citizenship or residency from that perspective is different from tax residency, and I'm going to work through a few of the considerations for tax residency. It's also different from what we call in South Africa financial residency. South Africa has this very frustrating thing called exchange control, which is quite unique to South Africa. And what exchange control did in the past, in kind of the apartheid era, was it required any funds leaving or coming into the country to be approved. Over time, those laws of approval have been relaxed somewhat, and Treasury is on a drive to relax them even more. But kind of change it more from an approval process to a monitoring process. They need to know what funds are coming in and out of the country, but they want to lessen the burden on it to South Africans. Why that affects us is because before March this year, there was a concept called where if you were immigrating, if you wanted to take all your assets out of the country, you would have to get your immigration approved by the South African Reserve Bank. And this process is what the press tends to refer to as financial immigration. So the financial immigration process is typically referring to the Reserve Bank process, and that has all completely changed from March this year. What we focus on more now is your tax residency. So when you cease to be tax residents, and this is something that people may refer to as kind of a tax immigration. So yeah, basically the whole process of immigration has changed from a residency perspective, from a financial residency perspective. We're not so longer concerned with the Reserve Bank process, but it's more kind of focused on tax residency. And that's meant that the old financial immigration process is a lot simpler, but it is a lot more focused on something that needs to happen through SARS as opposed to through the Reserve Bank.
Graeme, that tax residency, does that apply to where you spending your time in South Africa? Is there a tax residency test almost for South Africa, and then a tax residency test for the place that you're sort of working in or immigrating to? Is it a twofold thing?
Yeah, no, it's a good question. So it actually has three components to it, Mark. So and maybe firstly to understand is that every country has their own kind of tax residency test. Most countries it's quite simple. In most countries, it's as simple as if you spend more than 183 days there during their tax year, you'll be tax resident there. South Africa, it's a bit more complicated. So we got three components to determine whether you are South African tax residents. The first component is what we call ordinary residence. This is a common law test. There is no specific number of days that applies to it, but it's really if South Africa is the place that you consider to be your home. So you could spend no time in South Africa during a year, but it may still be your home, and you may still be tax resident here if you are ordinary residents here. And when we do opinions on ordinary residents, we go into a lot of detail, understanding where you are day to day, why are you going abroad, for what purposes, where the family are, where the pets are, what the different sizes of your houses in South Africa versus the foreign country, where your gym membership is, where your golf club membership is, where your church is, whether you're voting in the elections. All those types of things would indicate that you still consider South Africa to be your home. So it's the ordinary residence test. For you to cease residency based on that, you need a really strong indicator that you have moved abroad with a permanent intention. It will be a very difficult case to make on ordinary residence if, for example, you were moving to a place on a work visa, because then you don't have a permanent right to live outside of South Africa. So it's very difficult to say that you've left permanently, where if you leave your job, then you're going to have to come back home. And this was quite an interesting discussion for us over the last couple of years, because we spent a lot of 2018 and 2019 consulting with clients, and especially those that have gone to like Dubai and the Gulf region. And I would talk them through ordinary residence, and the feedback would be, I'm never coming back to South Africa. This is where I am now. After the UAE, I'm going to move somewhere else. I'm never coming back. And then COVID happened, and all of a sudden everyone was like, "Oh, I want to come back home." And I was sort of saying, "You've been telling me for the last 3 years this isn't your home anymore. Now you want to come back." So it's a change in intention, and intention is the key word there. The second component to tax residency is a bit more rigid. That's a physical presence test, where we count the number of days that you're in South Africa over a 5-year period, and if you exceed the required number of days, then you'll be considered SA tax resident. That's more a test designed to bring foreigners coming into South Africa into the South African tax net than to capture South Africans that are leaving. And this is why in Cape Town, for example, there's so many kind of British and German people that disappear every 5th year, because they're counting their number of days, and then they're heading to kind of break that number of days test. But the third and probably the most important component to tax residency is what we call the treaty test, or the double taxation agreement test. So South Africa has a vast treaty network. We've got loads of double taxation agreements, or DTAs, with different countries. And what those do is they will assign taxing rights or primary taxing rights to a specific country, because you should never be residents or tax residents in 2 countries at the same time. So if you now, say, for example, satisfying South African residency test, maybe based on ordinary residence, it's still your home, but you've moved to the UK and you exceed their number of days test, you now satisfying both domestic tests. The treaty needs to step in and apply a tiebreaker rule to determine who has primary taxing rights. And typically the country who has primary taxing rights can tax you on your worldwide income, whereas the country with secondary taxing rights can only tax you on the country, can only tax you on income sourced in that country. So this is a test that may work for or against you, because you may move to another country and want to attain tax residency, and then we can quite easily apply the treaty test, and we do that in Dubai quite successfully, where we get a tax residency certificate there, and we apply the tiebreaker rules to ensure the person's resident there. But in certain instances, you may not want to cease residency in South Africa, and then if you're not careful, the treaty may grant taxing rights to the destination country, and this will be in situations where people haven't done their planning in advance, and when you leave, there's certain tax consequences, which I'm sure we'll talk through. And so we need to be very careful that when people leave, they don't inadvertently trigger your ceasing to be tax resident before you've done your planning.
So Graeme, you mentioned 3 tests there. Do you need to, I guess, pass all three, or is it any one of the three in order to be classified as tax resident in South Africa?
It's I guess you could say any one of the three. If you satisfy any one of the three, you'll be SA resident. So how it applies, if you can think of it from this perspective, is the first two tests, so the ordinary residence and the physical presence, those will determine that you are SA tax residents, but the treaty test works in the opposite direction. So even if you are resident by virtue of one of the first two tests, but the treaty kicks in, that will override the other two and take you out of residency. Yeah.
Okay. Just we've got a question here from, I think it's Michaela. What are the residency considerations where you have dual EU and South African citizenship and you have no intention of returning to South Africa to live here? I guess where would you be termed resident?
Okay, so that's a good question. So we would need to understand, and this is, I guess, an overriding principle when looking at kind of making that jump or moving abroad is your first step is to go through kind of what we're doing now, which is to understand what happens in South Africa when I leave. But the second step is to understand what happens in the country I'm moving to and understanding their domestic laws. So we would need to understand where you're going to and what their tax residency rules are. So even in the EU, each country in the EU will have different residency rules, but most cases it's the 183 days. So if even though you've got kind of the dual, I'd say dual nationality, because citizenship, if I can digress for a second, I'm not an immigration lawyer, but in terms of your South African citizenship, if you take up citizenship in another country, you'll automatically forfeit your South African citizenship unless you get prior approval for it. You won't lose your ability to live in South Africa. You'll remain a permanent resident in South Africa. But if you do take up citizenship, now obviously citizenship is different to nationality, different to a passport, but that's getting into kind of immigration law. But yeah, the point I think to answer Michaela's question is that you would need to understand what the domestic laws in the country you're moving to, and from there we kind of work backwards and determine what is the date that you cease to be South African tax resident. And that, in this whole kind of immigration planning process, is the most important step, is to understand on what date that you cease to be South African tax residents. If planned correctly, in most instances, it's going to be the date that you get on the plane to leave, because that's when you're leaving with the permanent intention, and that's easily justifiable that you kind of breaking your residency. It can get a bit more complicated than that, because in certain countries like the UK, if there are instances where you can arrive in the UK sort of like later in the year, September, October, but their tax year starts in April, on the 6th of April, and they may take you back as a tax resident back to the 6th of April, and then that might actually be your day, even though you were still sitting in South Africa at that perspective. So determining that day is of utmost importance.
Okay. Thanks, Graeme. We've got another question here. What does SARS ask for as proof to show that you've relinquished your tax residency in South Africa?
Okay, excellent question. So let's talk a bit about kind of the compliance aspect. So the first thing to understand before we look at the compliance is what are the consequences of ceasing to be SA residents. And to understand that, we need to understand what South Africa has taxing rights on. So as a South African tax resident, so that SARS has taxing rights on your worldwide income and worldwide capital gains. How capital gains tax works is when you sell an asset, from a tax perspective, the profit that you've earned on that asset will be determined. That's your capital gain. 40% of that profit will be included in your taxable income. And that kind of process is important to understand when we start talking about the timing a bit later. But for now, we just remember that 40% of your capital gain will be lumped on top of your taxable income from all your other sources, from your salary, from your interest and investments and everything. And you'll be taxed on that in terms of the marginal rate. So the more you earn, the higher your tax rate goes up, with the top marginal rate of 45%. So when you cease to be resident, you must understand that from that point onwards, SARS can no longer tax you on your worldwide assets. They can only tax you on your South African sourced assets. So what the tax law says is there will be a deemed disposal of your assets at that point. So if you think about it, they will say, okay, Mark, you're leaving. Resident Mark is disposing of his assets to non-resident Mark. So there's a capital gains tax event at that point. What is excluded from the capital gains tax event is South African property. And the reason why South African property is excluded is because non-residents is going to be have capital gains tax on South African property anyway. So SARS will get their capital gains tax in the future, whether you're residents or not. Okay. And South African retirement assets, because those aren't really yours. You only have a right to them later. The retirement assets are currently going through massive law changes, and we'll talk through that a bit later. But the important thing to understand then is when you cease to be resident, there's a capital gains tax event. So SARS will want to know on what date do you cease to be resident. And the best way to declare that to SARS is in your tax return. So in your tax return, there's now a question that says, did you during the year cease to be tax resident? If you tick yes, it will ask for the date. And what happens from there is two things. So one, it will open up your capital gains tax section of your return, because it will assume that you've now disposed of those assets, you must declare it. And the second thing that happens is the return is then selected for what they call a manual assessment. So it's not the normal automated assessment where if you do your tax return, you get it back in a couple of seconds. It will take about, we're now currently seeing it's taking about 3 or 4 weeks to come back. And technically during that time, they can then ask questions, ask you to prove why you think that you're no longer tax residents. And those questions may be about the ordinary residence things. They may ask for a residency certificate or proof that you're a tax resident in another country. They could ask anything. What we're seeing though is on that, and I don't know if they're just overwhelmed with the applications or a bit slow to catch up on the technical side, but they're not really asking questions at that point. They're more just worried that the capital gains tax is concerned. They're not asking for proof of residency, but I suspect that they will start asking more about those in the future. And then, yeah, they can ask any number of questions about those kind of 3 components of tax residency that I mentioned in order for you to be able to prove that you no longer consider tax residents.
Cool, thanks, Graeme. Just before we get to another question, I just wanted to chat about that deemed disposal. So at that date, when you say deemed disposal, whether or not you sell those assets, you've got to, like you said, you're selling it from tax resident to non-tax resident market. You've got to account for the tax. So if you don't liquidate it, there's this 40% that's going to be taxed at your marginal tax rate it's a cash flow event basically that you need to come up with. So it's important to sort of understand how we're going to fund that if we don't actually dispose of those assets. Do you have sufficient liquidity elsewhere?
Yeah, it's an excellent point. So, I mean, you're being asked to pay tax on something that you haven't received the money for. So where we run into issues on the deemed disposal is on your discretionary assets. So people have unit trusts or share portfolios, or our biggest issue is when people have shares in private companies, so operating companies, because people might want to keep the company going, or it might even be a property company, in which case you don't want to sell the property, but you don't hold a share in the property, so you're not getting that exclusion. You've got a share in a company, so you're not going to sell that, and you're not going to have the cash for it. Or like foreign properties, people won't necessarily want to sell those. For the where it becomes incredibly pervasive, almost intrusive, is when you move to certain jurisdictions that don't recognize, I'm going to get a bit technical for a bit, but they don't recognize what we call a step up in the base cost. So if you move to, say, the UK or the US and you're holding those assets, when you sell them in the future, they're also going to charge you capital gains tax, but from the original cost of those. So if you think from this perspective, you've got assets with 100 that you bought for 100 and you leave South Africa, they're worth 140. SARS is going to tax you on that 40, but then in 5 years' time in the UK or the US, you sell them for 200. The IRS or HMRC are going to tax you on the 200 minus the 100, not the 200 minus the 140. So on that 40 that you pay to SARS, you're going to pay, it's almost like a double tax. So what we tend to want clients to do then is take it as an opportunity to kind of relook at their portfolios. If they're happy with their portfolios and their strategy, then we say, okay, well then sell and buy the same day, because at least then you kind of rebasing yourself and you've got an actual disposal to pay CGT on. But if you not, then kind of relook at your whole financial strategy and come to someone like yourself to work through it and understand because you're going to be paying the tax regardless, so you may as well have
so in that event, Graeme, so what you're saying is, you've got the deemed disposal in South Africa, right? So you've got the tax payable on that. If you then don't actually dispose of it, and you say move to the UK and you sell it at a later point in time, they're going to want their tax on that as well, right? So is there a way to avoid that? Can you sort of liquidate everything and move into the UK, basically resetting the base cost of the assets when you move to the UK? Is that kind of the way around it?
Yeah, that's going to be best. Yeah, and I mean, for discretionary assets, so your unit trust and share portfolios, it's relatively simple to do that. Obviously, properties, it's not as simple to kind of do that. We call it like a bed and breakfast. So you sell today, leave, and then buy on the other side. And that works quite well. Look, the CGT the capital gains event sounds scary, but in most instances that we encounter, when people are leaving permanently, they typically take it as a time to liquidate everything, and then they leave with their cash and they want to set up on the other side. So then you're paying your CGT and you're saying goodbye to SARS, and it's not as scary as it sounds, but it is really a big consideration when there are those kind of shares in private companies or bigger share portfolios that you want to rebase or foreign properties.
Yeah, I think a point there is it doesn't have to be as scary as what we think it is, but it is good to sort of plan in advance so you can get a whole picture as to what it is going to play out.
Absolutely. Like, I mean, I can tell you kind of like some horror stories on that. I mean, my worst situation is when the person has been in the foreign country for a year already, and then we can't kind of retrofit it. I mean, one of my favorite stories on Emigration is for this exact reason, the kind of rebasing thing. We had a client that, we only took advice. We only worked on their advice sort of a week before they were flying. And we ended up, for a whole variety of reasons, kind of stopping them at Heathrow and sending them to Paris for a week while a property transfer went through, so that they didn't enter the UK tax net and then have the historical capital gain on the property. So it can get the timing and kind of the planning for it is of utmost importance.
I think I just want to make a note here. Wendy, Dustin, I've seen your questions. We're going to address them now. This is just, and I think it's Chanel, this is just quite topical on what you're saying. Is Monique saying she's already immigrated to the UK, but working remotely for a South African company, earning rands into a South African account and just using her allowance to send the money across. Does she need to be in South Africa for a number of days and a year to remain the SA tax resident and avoid double taxation?
So I think that on something like salary income or remuneration, you're never going to get double taxation. So the treaty will prevent that. So if we went through the process of understanding Monique's circumstances, and I think an important point to make here is this isn't something that can be done through kind of reading news articles and that sort of thing, because is completely different. Every single situation has a nuance to it that is different from the previous person. But for me, for Monique, I would say, look, there's nothing wrong with doing it how you're doing, even if you are non-residents, and South Africa was still taxing you on that income. The HMRC will give you a credit for any South African tax that you pay, so you won't pay to SARS and HMRC. If we can dive into your personal circumstance just for a second, what I would say for that is, from an employment perspective, our South African law generally only imposes taxing rates on employment if you're physically situated in South Africa. So there would be an opportunity or a case to be made that South Africa, even though you're working for that South African company, they wouldn't have taxing rates on that income because you're not physically situated here. But that being said, your employer, they're the ones who sit with the risk on terms of withholding the pay as you earn and that sort of thing. So that would be tax advice that I think the employer would get to kind of understand how to declare it correctly. And if you did want to kind of claim that you're not taxable to SARS, then it's a conversation one would need to have with the employer and their tax advisors.
Okay. This comes up quite often. Dustin's asking, would it be advisable to place assets into a trust to reduce these complexities before immigrating? Does that help at all?
Okay, so on the trust question, I've got two kind of comments on that. To get your assets into a trust, you're going to need to either donate them or sell them to the trust. Either way, there's going to be capital gains tax at that point. So it's not going to help reducing your capital gains tax, but it may reduce the complexity, because then you're leaving without any assets in your name and there's less to declare and all that sort of thing. However, when we look at how trusts are taxed, we find the following. If it is a South African trust with a foreign beneficiary and it sells an asset, so the way trusts work is if they have taxable income, so whether capital gains tax or interest or dividend or whatever, and they distribute it to the beneficiaries, the beneficiary can be taxed on it, which is beneficial because individuals are taxed at a lower rate than trusts. However, that's different if they're foreign beneficiaries. If they're foreign beneficiaries, you can't assign that capital gain to the beneficiary. The trust will need to be taxed on it. And the differential there is massive, because a trust pays CGT at 36%, whereas an individual pays CGT at a maximum rate of 18%. So I wouldn't advise doing it from a tax saving perspective. What I would rather look at doing is potentially liquidating, taking the cash offshore. And if for an estate planning or whatever perspective you want a trust, then you look at an offshore trust in one of the kind of trust management jurisdictions in the Channel Islands or Mauritius or something like that.
All right. So maybe it's not a bad time to chat about retirement assets. So Wendy's asking from a retiree perspective, but if you immigrate and you're a retiree, what happens with the provident or pension funds in South Africa?
Okay, so let's from a retirement perspective, there's a few different things to consider. So maybe if we can take it back to the financial immigration discussion. So before 1st of March this year, if you wanted early access to your retirement savings, you would be able to do that if you did a Reserve Bank immigration. So whether you tax resident or non-tax resident, your consequences on actual retirements, those don't change. You can only access when you're 55, and there's the third that you can take as a lump sum. The rest is commuted to living annuity. But what we were doing in the past is when people went through that Reserve Bank immigration, they could early access their RAs and stuff like that. And in order to do that, you needed the Reserve Bank clearance to say that you had immigrated. Now, what happened from 1st of March this year is the law changed to say that when you immigrate, because we're not doing that Reserve Bank process anymore, you need to be able to prove that you've been a non-resident for at least 3 years before we'll give you access to those retirement funds. So as it currently stands, when you leave, if you want to early access your retirement savings, you need to wait 3 years after you've left in order to access those. But quite interestingly, what that law did was it created a loophole. And the loophole is that in terms of most DTAs, in terms of most treaties, the taxing rights for retirement savings sits with the country of residence, not with the country of source. So if you moved to the UK and you're a UK tax resident, the UK has taxing rights on your retirement savings. So the law was saying, okay, we're only going to give you your retirement savings once you're non-residents, but now we don't have taxing rights on it anymore. So they shot themselves in the foot. So they've now introduced new legislation, which will be effective from March next year, which is currently still in the process, and it's very poorly drafted legislation. And there's been a lot of kind of public feedback on it. So we're expecting the comments to come through within the next month on it. But what the new legislation will do is, if you immigrate, they will market value your RA at that point and impose a tax event at that point. But you won't have to pay the tax yet, because obviously you can't access your retirement fund, so you shouldn't have to pay it. But when you do access it in 3 years or 4 years or 5 years time, at that point you're going to have to pay the tax with interest from when you left. So there's going to be a tax amount payable then, but it's going to be based on the market value when you left. So you're not going to be taxed on any growth in your retirement funds over those 3 years. They've exceptionally complicated their lives, and we're hoping that the law will be simplified. But that's what it currently stands at. For people that do actually retire from their funds, there's kind of two comments on that. So people that have reach 55 and then kind of access their retirement funds. So there's still the kind of third you can take as a lump sum, and that's taxed on the retirement lump sum tables, and it's the fund will get the directive, and that will all happen quite simply. But if you're resident in the other country, you can get a directive so that you're not taxed on your retirement annuity as and when it pays out, and you tax on it in the foreign country. But what the other consideration with that is, and it's going more into kind of your world, is living annuities, because often when you take your third, then you'll commute the rest into a living annuity. Living annuities can never leave South Africa. So they'll always be based in South Africa, and you'll always only be able to take your 2.5% to 17.5%. You'll never be able to cash that out, whether you've immigrated, whether you're tax resident elsewhere, whatever the case is. That will always be have to be based in South Africa.
In that instance, Graeme, so you'll be drawing an income from the living annuity, which would be taxed in South Africa, right? And then the income you would just take over to the foreign, wherever you sort of moved to, and then potentially pay tax on that income there, or the double taxation would come into play there.
No, the treaty will come in. So you would get a directive to say that because you've ceased resident, you won't be taxed on it in South Africa.
Okay.
Yeah, but my point is, you just can't you'll never be able to take more than the 17.5%. Yeah.
Yeah. So I think in that scenario, I guess the trick there is, if you retire from that, like your pension, for instance, at work, if you retire, it's got to go that route. But if you resign, then you've got other options, right? So then you can move it into the preservation fund, and you can pay the tax and take the lump sum.
Yeah. That's right. Yeah.
Okay, so we've got another question here. Let's just see here. So this is from Anonymous. They're moving to Spain. I think you've answered on the asset question, but would South Africa be able to claim tax on their Spanish salary that they're earning there?
So if you still tax residents of South Africa, so if you don't cease residency, then South Africa has taxing rights on your Spanish salary. But that's where we look at that change in law, the foreign employment exemption that I started off chatting about. And how that works is, and I need to say this probably a few times, is it's only relevant if you're still South African resident. So it's only relevant if you kind of abroad on a temporary basis and you still consider yourself South African tax resident. So if you are employed abroad and still South African tax resident, what we do is we first look if you eligible for the exemption, and you would be eligible if your income is employment income. So it's not going to be, the exemption is not going to apply to independent contractor income. It's not going to apply to investment income or any passive type of income. It's only applicable to employment income. You need to be out of the country in a 12-month period for at least 183 days, of which 60 of those days need to be continuous. So the people that will kind of work, a month off, a month on, a month off, that can be complicated. Then sometimes we send them on holiday for a month, because you don't need to be out of the country the whole time on employment. You just need to be out of the country for more than 183 days, of which 60 days is continuous. If you're eligible based on that, then we look at your employment income, and that's all costs of employment. So your fringe benefits, your housing allowance, the school fees, all sorts. We calculated in rands, and the first 1.25 million rand is exempt from South African income tax. And then the rest is tax. And you take it back to as if that's the first rand that you've earned. So you're at the bottom of the tax tables then. They're not applying it at the kind of 1.25 million rand level. That's what your tax is. What you also get then is, if you're paying Spanish tax on it, you get a credit for any Spanish tax that you paid. So often in a country like Spain, which is going to apply quite a high tax rate, you probably, even if you're still SA resident, you're probably not going to have to pay too much to SARS. It becomes an issue in countries like Cayman Islands or Bermuda, who aren't taxing you on your income. It's difficult to get tax residency certificates like you can in Dubai, and then you're ending up having to pay a wad to SARS.
Okay, you've addressed Rupen's question here in terms of claiming tax back. I think that's great. Amelia's asking, if you open a foreign trust, can you transfer South African property into that trust, and will it still attract capital gains tax?
Okay, so the first, from a tax perspective, if you sell anything into a trust, it is going to attract capital gains tax. A trust is a completely separate person, so it's the same as you selling it to someone on the open market. There's a capital gains tax event on that. In terms of South African property being owned by a foreign trust, again, before January this year, a no-go, because exchange control kicks in, and I'm going to introduce you to another new concept called looping, which says that as a South African exchange control resident, you can't have a beneficial interest in a foreign structure which owns South African assets. That's also all changed as part of their kind of strategy to relax exchange controls. So as it currently stands, that would be possible for a foreign trust to own South African property, but it will need to be pre-approved by the Reserve Bank.
Okay, I think just on the trust thing, it sounds to me from what you're saying that the trust structure is not going to get rid of tax. You can't avoid tax by moving the assets into trust, because on moving it's a disposal. There's the donations tax, there's the capital gains tax. The tax is still going to apply. In some instances, it may just make things slightly less complicated, right? Yeah. But there's no way around the tax. SARS have sort of covered all of those loopholes that were there. So trusts, my view is, unless you've used them correctly from the beginning, there's no real benefit of trying to hide assets. There's no hiding assets anymore, but via that.
Yeah, absolutely. And I think it was Dustin or one of the guys asked about the complexities. So trusts are useful in eradicating complexities. They're very useful if you want to have assets in multiple jurisdictions. It starts getting useful from an estate planning perspective then. So foreign trusts, very expensive. So firstly, we need to make sure that that the assets are going to earn enough income to kind of balance out what you're going to be paying an exorbitant amount in administration and trustee fees. So that's the first comment on foreign trust. But if you are buying assets in multiple different countries that are based in multiple different countries, you then need to think from an estate planning perspective. I need a will in each different country, and when I die, my beneficiaries or heirs are going to be tearing their hair out because they're going to be dealing with all different governments to wind up the estate. So then it's better to have the foreign trust that owns those assets, because then you're just sitting with one asset, which is typically a loan account with the trust, and that's the only thing you need to worry about. So yeah, foreign trusts have their place, but really need to be well thought out and well planned.
Yeah. I just want to touch, Michaela is just asking if we go over what occurs if you resign from your South African employment ahead of retirement and move your retirement savings to a preservation fund. So Michaela, what we're saying here is, if you retire, then the retirement rules will apply to your pension fund or your provident fund, where you can take a third and 2/3 has to go into an annuity of sorts. But if you resign, then you can move that money into a preservation fund. And the rules of the preservation fund state that you can take one withdrawal before retirement. That withdrawal, though, is taxed. So it's taxed according to withdrawal tables, which applies a higher tax rate than retirement tables. But doing that allows you to access the lump sum. Yes, you're going to pay tax, but basically, I think it's like 36% on the amount over R1 million, something like that. So it is a whacker tax, but it gives you the opportunity to access the full amount of capital. Yeah, just to cover that. Ramesh is saying, would moving assets into a company be better than a trust?
Yeah, I mean, again, it depends on the type of assets, but again, to move the assets into a company, there's going to be a capital gains tax event at that point. So it may help with the complexity, just because you may then, instead of holding multiple different assets, you would just hold a share in a company, but that share in the company has value also. So you're going to pay capital gains tax on that value when you leave. So yeah, again, similar to the trust, I think reduces complexity, but it's not going to save you any tax.
Yeah, I think, we've got 10 minutes, so maybe just to kind of wrap up a little bit is, the tax consequences are going to be incurred. I think the key thing is to sort of plan this move in advance with your financial planner and then with a tax consultant like Graeme, so you get a good understanding as to what is going to happen at what point in time, so you can make the necessary amendments to your assets, to your portfolio, get them into the right accounts, so that you don't end up paying tax on a deemed disposal in South Africa, take that money to the UK, for instance, and then they tax you again on that money. So that planning process is very important. There will be tax. It's just sort of figuring out how we minimize it, I guess. And then I think another thing, Graeme, like you provide both local and international knowledge, but I think from a tax perspective, you're the South African guy, and I think you typically liaise with the foreign girl in the new jurisdiction that they're going to. Is that right?
Yeah, absolutely. Yeah. So we would always do this type of advice with someone in the foreign jurisdiction to make sure that we're doing everything fine there. We have enough knowledge on many jurisdictions. Obviously, the bulk of our work dealing with South Africans, it tends to be UK. So we have a decent knowledge with UK, but we almost we consider ourselves GPs in the UK. We need to find a specialist to kind of help the nuances. What we also do, which I haven't really touched on too much, is when you do want to take the funds abroad, so you're going to declare you cease to be residents in your South African tax return, but to actually take the funds abroad, you're going to need a tax clearance certificate as well, and that's going to be applicable if when you take funds in your year of immigration, but also in future years. Every time you're taking money out of South Africa, you're going to need a tax clearance certificate. So we always say to people, if you've still got assets here, keep your tax profile alive, keep submitting the returns, even if SA only has taxing rights on your SA sourced income and you don't have any SA sourced income, you're just kind of holding passive investments, still submit the nil returns, keep the tax profile alive. The one kind of change in people's world once they've moved abroad is, as I think most people understand now, as South African tax residents, from a Reserve Bank perspective, you can take that 1 million rand discretionary allowance abroad quite easily. So you get 1 million rand per calendar year that you can take abroad, and then up to 10 million above that. So from 1 to 11 million, you need to get a tax clearance certificate. How your world will change is, in the year of immigration, you get that 1 million, but in the future, you don't get that. So in the future, every time you take funds out of the country, you're going to need to get a tax clearance certificate. So it's very important to kind of keep your tax compliance status alive and get all of that in advance, because we often run, I'm sure you do as well, Mark, run into that situation where people are saying, oh, you know, the rate is like really good at the moment, I need to take funds out, and then we need to get the clearance certificate, and it's a process. So the planning is important.
Yeah, I think, again, we're saying planning, right? You know, so if you want to take money out the country over the next 12 months, you know, don't wait until the rand's at whatever you view as a favorable number. If that's your plan, apply for tax clearance in the beginning of the year, sell it for 12 months, and then you sit with it, and you can take out whenever you want.
Fully agreed.
I think just Linda's asking here, what is the amount that a minor child that is a taxpayer can take out annually without tax clearance? That's an interesting one.
200,000.
200,000.
200,000. Yeah. So adults get 1 million, minor child gets 200,000.
Is that specific to a minor child that is a taxpayer?
No, any minor child, and you can take it out in your parents' name. Yeah.
Okay. Okay. Cool. Graeme, is there anything else from your side that you'd like to add before we close?
No, I don't think so. I think we made quite a bit of good ground here. I think, yeah, the main kind of two principles that I always just repeat 100 times in sessions like these is planning, like planning. I know, Mark, you're on the same page as me on that. Yeah. And then also everyone's situation is completely different. So yeah, it's really important that you get specific planning pertaining to your circumstances and your plans.
Great, Graeme, thanks so much. This has been really valuable. You know, we've had loads of interaction, which is awesome. You know, we've had a couple of questions. People are asking how can they get in touch with us. So you can reach out to Graeme via his LinkedIn profile. It's the easiest way. Marcus is going to put the links in here. He has done it already, but he'll put them in again. And if you'd like to get in touch with us, you can reach out to us via LinkedIn or the website. Marcus will put those in there. And then just lastly, immigrating is a huge decision, you know, for you and your family. And typically we make the decision for our family. That's why we're going, right? But the financial implications can also be large if you haven't done it correctly. It's not just a case of, you know, moving and then dealing with it, right? Because the taxes become a big thing. So it's definitely something that we advocate you plan well in advance for. Speak to a planner, get in touch. You know, all of these people need to speak to each other. So the planner needs to speak to the tax consultant locally and abroad, just to help smooth out the move. Yeah, thanks very much to everybody who's attended. Graeme, thanks a lot. We've really appreciated it, your time. Yeah, and yeah, thank you very much for being here, guys.
Thanks, Mark. Thanks everyone. Enjoyed it.